Wall Street is suddenly waking up to the fact that AI might impact a larger number of industries and faster than they had expected.
And speaking of AI, it could save you time and money if you're looking to buy a new home. It's now being used for home buyers and renters.
For decades, the safest bet in American finance wasn't a blue chip stock or treasury bond. It was a prime mortgage. 30 years, fixed rate, stable job, money good. But that confidence hinges on one assumption: high earners stay high earners. As AI moves through white-collar industries, Wall Street is confronting a generational question. What happens to housing when six-figure jobs aren't secure? That's the warning from Citrini Research. The threat isn't subprime debt or rate shocks, it's structural.
What this story is about is how AI disruption fear is leading to sell-offs in parts of the market outside technology.
Mortgage markets depend on long-term income stability, and AI may be eroding that foundation. Many borrowers, the firm argues, may have borrowed against a future they can no longer afford to believe in. The top 10% of earners drive more than half of consumer spending and effectively set housing markets. If AI compresses those incomes, the shift won't begin with foreclosures. It will begin with hesitation. Fewer bidding wars, slower price growth, pullbacks on upgrades and second homes.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms.
In tech-heavy cities, even modest income uncertainty can ripple through valuations. All of this is unfolding as Wall Street celebrates an AI-fueled bull run. The Magnificent Seven are projected to deliver roughly 23% net income growth, and investors have cheered automation-driven margin gains. Yet beneath the optimism, layoffs are mounting. According to Challenger, Gray, and Christmas, employers have announced more than 1 million job cuts in 2025, including over 141,000 in tech, with more than 31,000 tied directly to AI restructuring. In October alone, layoffs jumped 175% from a year earlier, the highest for that month since 2003. The symbolism is hard to ignore. The very sector that drove post-pandemic job growth is now trimming aggressively in the name of efficiency and artificial intelligence. And while 141,000 jobs may be small relative to a workforce of 160 million housing markets, are not evenly distributed across that workforce. They are acutely sensitive to concentrations of wealth.
In our current housing market can be frustrating, it can be expensive, and it's almost always time-consuming. But companies that work with both renters and buyers are now turning to the hottest thing in tech right now.
Jake Krimmel, senior economist at Realtor.com, urges caution. He does not expect tech layoffs alone to derail the national housing market. In his view, the scale remains modest in the context of total employment, but he acknowledges the geographic nuance. In places like San Jose, San Francisco, and Seattle, metros heavily reliant on technology salaries, price growth could soften if layoffs persist or roles vanish permanently rather than temporarily. That distinction matters. Are companies simply restructuring, trimming excess hiring from the pandemic boom, or are they permanently replacing functions with code? The answer determines whether housing sees a brief wobble or a more durable shift. Economic data often lags lived experience. It can take months or even a year for layoffs to translate.
Yeah, well, that report looked a lot at skills, but it's also a lot of workers and aspiring workers in tech, and you imagine a lot of those are younger people.
Into visible housing trends. By the time median price declines appear in official reports, sentiment has often already shifted. One moment in particular felt like a public crossing of the Rubicon. When Jack Dorsey announced that his financial technology company Block would lay off 40% of its staff due to artificial intelligence, investors didn't recoil. They applauded. The stock price surged. In a letter to investors, Dorsey made explicit what many executives had only implied. Intelligence tools have changed what it means to build and run a company. A significantly smaller team, armed with AI systems, could do more and do it better. He went further, predicting that within a year, most companies would reach the same conclusion and implement similar structural changes. The subtext was unmistakable. This was not a cyclical belt-tightening. It was a philosophical shift.
Still reported strong financial reports for its most recent quarter. Dorsey says he wanted to act decisively rather than gradually, and believes many other companies will make similar decisions.
Replace labor with capital. Replace payroll with software licenses. Replace long-term human cost with scalable automation. Economist Moshe Lander of Concordia University described the trajectory as a hockey stick. Years of gradual automation, followed by a sharp upward acceleration. Investors appear to see the same curve. If profitability rises when headcount falls, markets reward the pivot. But housing markets do not operate on earnings multiples. They operate on household incomes. Mortgage-linked exchange-traded funds sit directly atop this delicate chain. The iShares MBS ETF, the Vanguard Mortgage-Backed Securities ETF, and the iShares Mortgage Real Estate ETF all depend on the stability of underlying borrowers. If income volatility rises among prime borrowers, historically the safest cohort, pricing assumptions embedded in securitized credit may need recalibration. Banks, mortgage lenders, and consumer discretionary sectors are not insulated from that adjustment. Yet, the broader employment backdrop complicates the narrative. In the absence of official government data during the recent shutdown, alternative indicators such as private payroll reports suggest moderation rather than collapse. Unemployment has edged slightly higher but remains historically low.
On Wall Street, markets at record highs as excitement over artificial intelligence drives big-time money into stocks. But that same technology may also be transforming the American workforce.
Private payrolls continue to grow, albeit more slowly. The labor market appears to be cooling, not cratering. This ambiguity is precisely what makes the moment so combustible. Markets dislike uncertainty more than bad news. If AI-induced layoffs are contained and offset by new industries, housing demand may bend but not break. Georgios Petropoulos of the University of Southern California argues that AI-driven productivity could spur entrepreneurship, new startups, and fresh avenues of growth that absorb displaced workers. Historically, technological revolutions have eventually created more jobs than they destroyed, but eventually can be a long time in housing. Mortgages are written for 30 years. Homebuyers stretch finances based on expectations of rising earnings, stable bonuses, and career progression. If even a fraction of high earners begin to question that trajectory, psychology alone can cool demand. Housing is as much about confidence as it is about cash flow. North of the border, the picture looks somewhat different. A recent analysis by TD Economics found Canadian industries aggressively adopting AI have shown more resilient employment trends than their U.S. counterparts. Sectors such as finance, real estate, and healthcare have not yet exhibited the same divergence. Canadian policymakers are racing to balance adoption with protection. Prime Minister Mark Carney has pledged investments in retraining and digital skills, seeking to accelerate productivity without hollowing out the labor base.
Merci tout le monde ici à ce fleuron canadien, ce fleuron québécois. C'est un grand plaisir d'être ici, de retour à Montréal, d'être chez CAE, un chef de file canadien en défense qui fabrique ce dont le Canada et le monde a besoin.
A $50 million initiative aims to help workers transition into new roles, extending benefits and funding AI-related training. The contrast raises another uncomfortable possibility. AI disruption may not unfold uniformly across borders or industries. Some metros could experience acute recalibration while others remain buoyant. Housing markets are local, even when capital markets are global. The deeper concern, however, is philosophical. For decades, the American housing system has rested on belief in income growth, belief in career stability, belief in upward mobility. When borrowers sign mortgage documents, they are not merely committing to monthly payments. They are committing to a version of their future selves, employed, progressing, earning more at 45 than at 35. If artificial intelligence compresses that arc, even subtly, underwriting models may prove overly optimistic.
A lot of, especially large tech companies, is that they're all experimenting with what AI can do for them. But keep in mind, we're also in the very early stages of AI adoption.
None of this guarantees a housing crash. There is no wave of subprime resets looming. Lending standards remain tighter than they were in 2006. Household balance sheets, in aggregate, are healthier. But systemic risk does not always announce itself with obvious excess. Sometimes it creeps in through structural change. If AI continues to reshape labor markets, housing could become one of the most important transmission channels between technological disruption and financial stability. Mortgage-backed securities feed pension funds, insurance portfolios, and global investors. A recalibration in perceived borrower stability could ripple outward, and yet optimism persists. Innovation has always unsettled before it enriched. The same technology displacing certain roles may unlock industries not yet imagined. AI-driven productivity could lift GDP, raise wages in complementary fields, and spark new waves of entrepreneurship. Governments are rolling out retraining programs, universities are retooling curricula, and startups are launching at full speed. The real question isn't whether AI will reshape the economy. It already has. It's whether labor markets can adjust fast enough to protect the income stability housing depends on. Can policymakers ease the transition without choking innovation? Can investors celebrate cost cuts without confronting what shrinking payrolls mean? Prime mortgages have long been financial bedrock.
Although it hasn't been seen in large numbers, over the next several years, there will be some impact on the job market.
But even bedrock shifts when the ground beneath it moves. As 2025 closes, AI remains Wall Street's favorite trade. Earnings up, stocks climbing. Yet between the trading desk and the front door of a new home, a quieter recalibration may be unfolding. If the future of work is being rewritten in code, housing may be rewritten with it. And the next stress test may start not with a missed payment, but with a job that suddenly vanishes.